Earlier today, the Personal Consumption Expenditure Price Index, which tracks inflation, ticked higher, surprising both Wall Street analysts as well as economists. And when you parse out the data, you see core goods has gone below what the Federal Reserve is targeting, around 2% threshold. Housing is expected to roll over, especially with high mortgage rates. But the services market, that is the problem that arguably reflects stickier inflation. And it had started trending to that 2% target that the Federal Reserve has. But seeing the recent data, this is both the black as well as this beige line here, seeing it tick up does make investors think and economists think that this battle with inflation is not over. This is going to be a stickier, this is going to be a harder battle. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, please make a point of hitting that subscribe button. So let's understand, well, what does this mean for the stock market to see potentially stickier inflation? Well, immediately, various different stock indices gap down between 1% and 2%. Now, it's been bouncing around this level. Honestly, this reminded me a bit of Michael Burry at the end of January, where he tweeted sell. And then immediately following, the stock market rallied a couple percent higher. Everyone was dogging on him. What's Michael Burry? No, he's always saying the same thing, broken clock. And I honestly think he's right. And he was talking about how, look, inflation comes in cycles. It's not easily solved when it easily gets entrenched in the economy. And he'd also talked about the general long-term trend line of the S&P 500 and saying, hey, yes, it might have recently rallied, but there's a good chance, especially with continued monetary tightening, that you could see this head lower, potentially making new lows later this year. A lot of folks thought October was the low. Looking at this data, especially with worsening inflation, could this mean you see tightening monetary policy resulting in much lower stock prices ahead? And that really is the concern that investors are considering. That's what you see, at least based on the bond market. Looking at the one-year Treasury yield, a year ago it was around 1%. Now it's over 5%. And this creates a real challenge both for the economy as well as the stock market. Because when you think about borrowing costs, that means for corporations, the cost to borrow has gone up. If you're trying to buy a house, your mortgage cost has gone up. If you're looking at stocks, since the great financial crisis, you had a period of zero interest rates. Federal Reserve lowered interest rates to say, hey, we are going to solve the economy. The banking sector is going to get rich and the economy is going to heal. The byproduct was that investors said, hey, there is no alternative to owning stocks. TINA was the acronym that everyone said. TINA, there is no alternative. Now, we are in a period of 5% plus on a one-year Treasury. So there is an alternative for investors. I personally keep my cash at Interactive Brokers, which is currently yielding over 4%. See the link below for Interactive Brokers. And so I look at this, and this is the real challenge for the stock market. If you have an S&P 500 trading at 18, 19, 20 times, you need to have really compelling growth to say, hey, I'm going to own this in lieu of getting a 4 or 5% yield. That's the challenge that I think investors in the stock market is increasingly facing, is valuation comes under pressure. The stickier and tougher monetary policy has to be to fight inflation. And that's the data that we're seeing here. And you see it with the one-year Treasury as well. Larry Summers, one of the sharpest economists out there, he previously was Treasury Secretary under President Clinton. He called inflation, by the way, back when everyone was saying it was transitory. So he absolutely nailed it. He's not getting into partisan politics. He's saying this is what the data suggests. What's he have to say about the latest data, what he thinks? He's saying, I think the chances of a soft landing, which looked to be getting better a couple of months ago, are now receding a bit. Honestly, this isn't the type of thing that most people like to hear. Most people prefer binary, hard landing, soft landing. And the reality is super forecasters, and there's a book on this which I highly recommend you read, Super Forecasting. They talk about how the best forecasters oftentimes think in sort of the gray zone, think in probabilities. And that's what Larry Summers is alluding to here by saying, look, the probability of that soft landing where unemployment's at record lows and the economy's still doing well and inflation's heading in the right direction, that soft landing, that probability, that's receding, even though it looked good. And that's part of the reason why the stock market rallied the last few weeks and months. That probability is now going lower because of this stickier inflation print, seeing inflation tick higher. That is a real challenge for the stock market and reinforces that thesis that you might either retest or make new lows with the S&P and some of the major US indices in the months and quarters ahead. So he's saying, look, you got to tweak your probabilities based on this data. The probability of a hard landing arguably has gone up. Okay, so what are my thoughts? How can you potentially benefit in this environment when a lot of stocks are getting hurt from a valuation and earnings perspective? Well, first, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. I also launched 2 new educational courses that I made thinking this is what I would have wanted to know when I first started at Wall Street, thinking about reading financial statements as well as how to understand valuing businesses. In full disclosure, this is not financial advice. So looking at this, and this is the crux of why, a lot of stocks, in my opinion, are going to face challenge, face a tough environment. You have that 5% yield, 4% plus for cash. And the only argument that you can make for stocks, because the valuations aren't cheap, even despite a lot of pain you've seen, a lot of valuations still aren't dirt cheap. So then the thesis becomes, well, you're going to see a lot of earnings growth, and that earnings growth will compensate you for why you should own stocks versus bonds. But then you look at what's going on with earnings in the most recent quarter, based on FactSet, you're looking at around a 5% drop in earnings. So when you have this, then you're in real trouble for stocks, because you have earnings rolling over, then you have valuations coming under pressure, because people say, hey, why should I buy things with let's say a 20 times earnings multiple when I can get a 5% yield with a bond? 1 divided by 20, you get the equivalent of a 5% shareholders yield. So this is why it's so important to be able to post growth. And when most companies are reporting earnings declines, that creates a real challenge for the market. And so let's understand the next step. Okay, so how can you benefit from this, seeing that earnings have started to roll over? I think the way to do this is to own things that win from stress. Nassim Taleb wrote a book called Anti-Fragile. You want to find the winners of stress. And I'm going to talk about one of these winners in just a second, but just thinking broadly, you want to find either management teams that are opportunistic, teams that have proven themselves over a multi-decade perspective. They've seen ups, they've seen downs, they've seen bad and good, where they can say, hey, we know how to act when things are good. We know how to act when things are bad. We can keep expanding, keep growing. We can buy our competitors when they're suffering. You want opportunistic management teams that know how to perform. And so that's where a lot of this is going to test a lot of management. So I personally want to see the folks, and I personally want to align myself with the folks that have already done it. The next part, another key aspect, the folks that win from stress, is this idea of cash benefiting in this current environment. And that should be fairly obvious. Cash now yields 4% plus. You can get 5% with 1-year treasuries. So companies with lots of cash, companies holding large bond portfolios, they can be a winner if they manage that intelligently. They can have a lot more investment income coming in. For example, if you own in a prudently managed insurance company, this can be a great time for them, because all of a sudden their cash and short-term bonds, which were previously yielding nothing, are now yielding a lot more. One of my largest positions is very much an insurance company that has proven their history, a multi-decade history of outperforming the S&P 500. They're directly benefiting from this environment. I talk about it repeatedly with my subscribers at unrivaledinvesting.com. Another key aspect in how companies can benefit in this environment. Keep in mind, most companies can't do this. Most companies cannot benefit from stress. But this is, you're asking yourself, how can I find things that benefit in this environment? Most companies will not do it. You want to find things that are so stable, so sticky, generating tons of free cash flow, that even if the worst, you have a terrible economic environment, revenue goes down a bit, they're still generating tons of free cash flow and can buy back lots of stock. So that way you can make sure you're still getting rewarded. Maybe it's a 5% stock buyback. Maybe it's a 10%. Just buying back huge amounts of stock. So that way your percentage, your part of the pie can increase throughout a recession. That's the way you want to be thinking about this, is that you're getting stronger no matter if you're facing a tough period, in the quarters or months ahead. So one example of a company that sort of checks out for this is Warren Buffett's Berkshire Hathaway. And I think Warren Buffett is going to be like a kid in a candy shop in this environment for a couple of reasons. One, I already called out with the insurance, portfolio. He has $100 billion in cash and short-term, bonds. That's billions of dollars in additional income that he's now going to generate. That's a huge victory for him. He's going to, deploy that in really intelligent ways. And by the way, Berkshire stock isn't that expensive. I'll do a video on it if you want, following their next quarter earnings results. So very impressive results. Another key aspect to consider, Warren Buffett's extremely opportunistic. When things are cheap, then he's going to be buying. And I did a video recently on his holdings. Oh, has he been a big buyer as the market rallied? No. He's waiting for things to get cheaper. He's been trimming his positions. So he benefits from cash, higher interest rates. He benefits from, an environment where things get cheaper. Now he can buy more. And I'd say this last component, this is really where it's going to shine for Berkshire and other players like Berkshire, which is that they are in a position to buy things when others cannot. And a lot of folks weren't aware of this, but in the prior period, the last, let's say, decade plus, as interest rates were at zero, Berkshire's advantage of having low cost float, meaning their insurance operations, which were operating at a profitable level, so effectively getting to borrow money for free, effectively, they could use those funds to make intelligent acquisitions, either in bonds, stocks, etc., or businesses. And using that float, they could buy these businesses, grow the business, grow Berkshire. They were at a disadvantage, or their advantage was no longer super compelling when interest rates went to zero, because then private equity firms could do that as well. They could say, hey, we can borrow super cheap as well, and we can bid for companies. Now that interest rates are higher, Berkshire's in a position to say, hey, we can still buy, we can still bid for companies, but all these private equity firms that are now looking at 8% cost of borrowing, they're no longer as competitive as Berkshire is to make an acquisition. This is a huge development that's happened now with a real interest rate environment that should put them in a position to make more acquisitions going forward because they have low cost insurance driven float. So I hope this example has been helpful for you. I hope this framework for thinking about the current economy and the stock market, where it potentially goes and how you can position yourself, has been helpful for you. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.